Okay, hello everybody. I think we start this corporate venture panel discussion. Thanks everybody for joining. My name is Martin Heidegger and I would like to start with maybe a short introduction of the panelists. So maybe Mitchell, you start introducing yourself and a little bit tell us about what the Roche Venture Fund is doing.
I'm Mitchell Lutz, investment director at Roche Venture Fund. I've been in venture for at least 6 months now, maybe 7. Prior to that, I was a serial entrepreneur. I started a tools company called LabSite, a therapeutics company called Amplix. I've raised $120 million in venture, and my companies employ about 200 people worldwide. Roche Venture Fund is an evergreen fund. It's a $500 million fund. We are not strategic. Our goal is financial gains, and we invest in the areas of therapeutics and tools and diagnostics. We do not invest in medical devices.
Hello everybody, Alicia Ihorzon-Lafitte. I'm a principal at M Ventures. So M Ventures is the fund of Merck KGaA, so the German Merck KGaA, I'm sure most of you are familiar. We have a fund of 300 million euros. Half of that is dedicated to healthcare and is an evergreen fund. And the other portion is allocated for strategic investment in the field of performance material, life sciences, and also what we call new businesses, so digital health and anything that is blue sky opportunities. I work for the healthcare team based here in Boston. We have a portfolio of 25 companies. We have a strategic mandate. So we cover oncology, immuno-oncology, autoimmune diseases, fertility, and drug discovery platform.
I'm Todd Brady. I'm the Director of Finance and Investments for Brace Pharma Capital. I'm sort of the hybrid of everybody around me. We are affiliated with the largest Brazilian pharma company, but we are sort of an opportunistic investor. If we can make something strategic, we will. If we want to just invest for financial gain, we will. It's a $300 million fund, started about 4 years ago. It is evergreen, and it's deployed across a wide spectrum of any opportunity that we just more or less like, and just the nature of having the investors in it that we have. So we'll invest all the way from preclinical, all the way up to actually be willing to help through commercialization, to take to commercialization. Bite sizes range from 5 to, which may sound crazy, 65 million, 70 million bucks in one shot, if we're really compelled and we want to take it all the way. And still deploying capital.
Hi, I'm Mary Nakata from JJDC, J&J's corporate venture arm, based here in Kendall Square, but we have 12 investors invest globally. We invest in all 3 sectors: pharma, consumer, and device, and all different sizes and stages from seed convertible notes to Series A, B, C. And in conjunction with strategic business development deals, we'll also do pipes into public companies. We are strategic first and financial second, and invest in areas of interest for J&J, and in the pharma space, there's 5 different therapeutic areas that we invest in.
Thanks very much, Marianne. So I'm Martin Heidegger. I'm with the Boehringer Ingelheim Venture Fund, and we are the strategic venture arm of Boehringer Ingelheim, also a strategic investor. Our strategy is a little bit unique in a way that we go into spaces that our parent company is not active in. So we are actually meant to go into white spaces, and then maybe in 5, 6, 7 years from now, our parent corporation decides to go into the spaces and has options to take over our portfolio companies if they pay the highest price, obviously. There's a firewall between us and the rest of the organization. So when we see confidential information, we don't share that with scientists within BI. We are all scientists in our group. We're 5 people. 4 of my colleagues are based in Germany at the moment. I am based in Boston. And we do invest 200 million into therapeutic molecules, ideally platform companies. We did a lot of immuno-oncology recently, so half of our 20 companies are in IO. And regenerative medicine becomes more important to us. We did both cell-based as well as looking for small molecules triggering in vivo regeneration there. So in a nutshell, that's the Boehringer Ingelheim Venture Fund. We always take board seats and we can invest up to 15 million per company. Okay. So I would like to actually open the discussion and questions. But before that, I actually would like to better understand who you guys are. And maybe I assume most of you guys are like with privately held biotech companies. So can you maybe raise your arms if you would like privately held biotech company? Okay, so that's most of the people. How many of you guys have raised?
You can write the checks now.
Yeah. How many of you have raised money already? Okay, and how many of you guys have corporate money raised, corporate venture money raised? Okay, so that's the minority. So we have there's a lot to be done here, obviously, for us. So I would like to ask the first question, and whoever wants to take it. So how do you actually source companies? Where do you get your opportunities from? Maybe Todd.
I think we lean towards a network through our advisor network. I think cold calls are probably the hardest thing to do when somebody reaches out. You really don't know enough about the person. You don't get that somebody sort of default vouching for the management team. So if it comes through one of our key advisors, one of our board members, or an employee, or anything those are the deals that definitely get prioritized. We also do like conferences like this where you get to interface with the management, but I defer to that. And then we do take in some through banks. We also like to do it through other key VCs that we like to partner with in deals. And so if I was to prioritize that, I'd say internal reference, people we like to invest alongside of, meetings at conferences, and then a cold call. And I don't think I've ever gotten past like the non-con deck on a cold call, unfortunately, because you just don't know.
Yeah, thank you. Mitchell, you want to comment or?
Yes, I'm sort of learning the ropes, but I would say a lot of the deal flow is from our venture friends, colleagues in the business. Because we're part of Roche, we've about 110,000 people worldwide. We do see a lot of deal flow coming in through colleagues. We have a large diagnostics division, and so a lot of diagnostics deal flow comes internally. Apart from that, we've got 3 partners based in Basel, and I'm one of 3 based in South San Francisco. And so I'm up at UCSF a lot, or down at Stanford, so we do see a lot just through the local academic ecosystem.
Mm-hmm. Thank you. Alicia, I know that the best opportunities you guys see are coming from the Boehringer Ingelheim Venture Fund, but beside that, where else do you find your companies?
It's pretty similar to our other colleagues. It's network. Cold calls are usually not going very far and don't get prioritized. It's co-investors. It is also our portfolio companies and also entrepreneurs we've worked with. Our R&D colleague can sometimes come up with some names. So in a nutshell, that's it.
Mm-hmm. Marianne, same for you guys?
Yeah, we have the R&D folks collaborate a lot with academics, so you can imagine if there's a Nature or Science paper that comes out that's eye-popping about, let's say, a novel target, everyone flocks to that PI. So a lot of the times the Janssen folks have interacted or collaborated or actually know because they train with these founders, scientific founders, and so those relationships have oftentimes allowed us to be part of the new codes that they found, irrespective of whether or not we did the heavy lifting. So I think a lot of it is about relationships and taking advantage of novel science that's published in top-tier journals.
Yeah, pretty much the same for us. Science paper always help, right? A lot of what we see is also coming through our network. I think in our portfolio of like 20 companies, actually one was just like a call run through our website. Everything else was coming through personal networks. I actually have to say I also enjoy early conferences. I'm not getting paid for that, like this one, because I keep saying we would like to invest early as the Boehringer Ingelheim Venture Fund, and I see very early companies at such conferences. Okay. Maybe, after you established first contact with the companies, how do you internally process it? So what are you doing internally to actually push towards an investment? And maybe Marianne, you can start.
Yeah, so we have folks whose role is to do search and evaluation, and they specialize in particular therapeutic areas. So they are the ones that are the front lines into determining whether or not it's like on strategy for the approach, the technology, the targets, make sure it's not overlapping with something we're doing, and then decide if we put a CDA in place. And then from there, if that's the case, maybe a broader team will have a look, ask a bunch of questions, and then from there, it's a matter of, okay, if we are interested, what kind of structure? And it may or may not involve equity.
Okay, how long typically does it take you from the first contact to kind of making a decision?
I would say, we probably try and say no within 2 weeks because it may take a while, and then to put a CDA in place and then decide whether or not we're going to move forward, it may take longer, maybe like 4 to 6 weeks.
Okay, Todd?
So the process for us is once we want to see a deal and we've taken in a non-con deck, we'll sort of do an internal kick the tires. Conceptually, does this make sense? Is this an area of interest? Does it seem commercially viable? Does it seem like it's going to have the funding or the backing that it's going to need to go? Once we get excited about, like, say, the literature or the team that's supporting it, we'll go under CDA. We'll then start going into an initial discussion with the management team, and then just start constantly interacting with them, getting more and more comfortable to the point where we think we're like, okay, is this going to get to a term sheet stage? And sometimes we're kind of a little bit probably different in that we'll run a term sheet process at the same time as we're doing the KOL discussions, which means we can have higher legal bills if we want. But I think once we're internally comfortable, it really comes down to the finding of the specialist KOLs, because we don't have the internal support like most of the people on the table do. Is that we will want is the best in class in the area to make the comment, usually 3 to 5 of them, to come out and say, like, yes, this is compelling. And during that time, we've gotten comfortable with the financial plan, the other members of the syndicate, that we've really vetted the management team, and that's when we would pull the trigger. In a syndicate situation, I mean, you do a little bit more of a piggyback, so you have a reduced amount of diligence from that standpoint once you're comfortable with another investor. So the decline for us can happen anywhere along the path. I mean, we've been post term sheet, it blew up in diligence. So, and then the deal dies, pens down. So it's very deal to deal for us.
For us, we start with a first evaluation within the team. And afterwards, once we have a CDA, and if the company is comfortable with it, we actually tap into the R&D expertise. We usually can go to 1 or 2 experts that could be interested into the technology, and we actually need to do that because we work through sponsorship, so we go at the highest level in the organization, and that's how we operate. If companies have sensitivities, working with our R&D organization, we also work with external KOL and consultants that we're used to work with.
So if you say team, Alicia, that's like the venture team?
That's our venture team, yes.
And that's like you based in Boston and they are in Amsterdam?
Yes, we haven't made a big team in Amsterdam, perhaps 18 people now in Amsterdam. We also have people in Israel where we have an incubator.
Mitchell, how long does it take you to come to a decision? I know you cannot say longer than 6 months because that's the time you're with Roche Venture,
yes,
right?
It takes less than 6 months typically. So first we like to receive a non-confidential deck, which we then socialize with the team members. We have weekly meetings. Because I'm in California, I have to get up at 5 to be at the conference room by 7. So we have this initial review, and then if it passes, then we'll go into a deeper dive, usually with a confidential deck. We reach out to internal diligence resources, but if the company has a sensitivity around that, then we can go to external KOLs because we want to be respectful of that. So we are happy to work within a firewall if that's the desire of the company. And I would say one thing about internal diligence, and I don't know if my colleagues have this experience, but you have to put a little bit of a filter on it because For example, at Genentech, there's a certain sense that Genentech is the best. And I think, while Genentech is very good, they perhaps are not always the best in every area. So you have to filter what is said a little bit, and sometimes go to an external KOL to get more of an unbiased opinion. But we can usually reach a decision within a few months. Sometimes things take longer, and as Todd was saying, diligence is diligence, and if you stumble upon something, even if it's very late, that can change things dramatically.
Yeah, thank you. And very similar to us, I mean, we typically receive non-confidential presentation first, then we have actually, that's I think the most challenging hurdle that we have to convince everybody in our group, the 5 partners, and especially the head of the venture fund is sometimes very critical to convince those guys. And once we have the buy-in, I think we go into the due diligence process, and that can take as short as like 6 weeks. It can take as long as a year. There were some companies we were discussing a year, but we wanted to see some more data that they created. And then there's a decision, and we write investment documents, and we have an investment committee, and then we can actually execute. I said what's a little bit special with the Boehringer Ingelheim Venture Fund, we don't consult with internal scientists, I think, which makes us a little bit leaner and maybe faster compared to many of our peers. Very good. If you guys have questions in between, feel free to jump in. Very happy to have this a more open discussion. But is there anything specific that you don't like to see from founders? When you do due diligence, is there an advice that you can give to those guys? Please don't do that, because it really will make it more unlikely that I invest, Marianne.
So, I guess one thing we don't like is when we don't see the science, because clearly I think that's what we invest in. And so, too much science, of course, well, there's no such thing, but I think the notion about, what is the evidence to prove your hypothesis, and do you have a sense of, the time and the cost? And so when those things sort of aren't thought through, the next value inflection point, those are things that are a challenge, because then we sort of have to dig for that.
Yeah, for me, personally, the worst thing is non-confidential decks where I don't understand what the company is doing. I get like no clue what is it about. And then people are very excited, but I don't get it, and that's certainly something which is not good for the further discussion. Todd?
For me, even in a non-con deck, I guess there'd be 2 things that drive me nuts. One, to your point, is if I can't understand a path to my value inflection, or it doesn't seem reasonable or well thought out, like you can't tell me like roughly what your patients, how many patients you need in your trial, what that patient cost is going to look like, when you think you can achieve it, does it even sound reasonable? Like, does it look like any other study that I've seen in that area? So when you show me your Gantt chart with your attached like budget numbers, it'd be helpful if if they're not completely delusional. I know that sounds basic, but realistically, we get a lot of things where it's like, this is just not viable. And the other thing is, and I think this is really hard for founders to hear, but it's almost like there's a self-awareness of their limitations. And I think this is something that VCs struggle with, and they struggle with in negotiations and communicating with the teams, the management teams. And it's a constant discussion, and it's a source of friction throughout the relationship. Is there sometimes founders need to get out of their own way to help bring the company to the next level. That could be in the form of dilution, their management, and their interfacing. It's like you need to be a little bit open-minded. If you're bringing a group of new directors in, they're trying to help you. They're trying to make money with you. Don't assume because you may face some dilution, or may they say you need to go to a CSO role down the line. It's because they're trying to bring value with you. Don't assume that it has to be head-to-head. And some founders, you can kind of meet them, and you're like, I love this tech, but this is just going to get stuck in like a constant friction and tension. It's just not worth it. And I think I assume everybody here on the panel has experienced this other than me, but I think that's one of the critical things. So if you can be a little bit open-minded when you're getting recommendations through the pieces.
Yeah, Alicia?
thankfully we don't get too upset too often. So I think a very clear and compelling story that you get through the slide deck quickly is important, because we just have a lot to go through, so that's helpful. And also doing your diligence before you come and pitch. If you know this is completely far off from what the fund is doing, be conscious of it. And if we've passed, like within past 3 months, and there is nothing substantially new, please come back when there is something new, because it's just a repetition otherwise.
So having spent more time raising money than investing, what I can tell you is under promise and over deliver. If you over promise and you don't make the numbers, don't make the milestones, then it damages your credibility. And I think a lot of what we all do in diligence is assess credibility and how we're going to work with you in the long term. So don't feel you need to make the story prettier than it is. And in your presentation, echoing a little bit what Alicia said, try to be very clear and crisp. What is the story? As a fund, we like first in class or best in class, and so we like to see that you've done your homework. Are you aware of the state of play in your field? What is the standard of care, and how? I'm sure your technology is great. We all love our technology, but you have to see through that and understand how you're going to improve upon what's out there.
Yeah. So there's a question, maybe.
It's true that you're all valuation. You don't care about valuation, right? You're totally valuation.
Oh yeah, that's the urban myth. Corporates don't care about valuation.
I'm just kidding. But in terms of valuation and leading deals, I mean, Mark, you did Sention with you, and you led that deal. But do all of you lead deals?
Yeah, I mean, I just can speak for ourselves. So we lead deals. Actually, all the investments we've done in the US so far, we were leading the deals. And valuation, obviously, is always like a very sensitive topic. To me, it's actually not a very important topic, because I think you can agree, and you should be able to agree on valuations. Many, especially early fund founders and companies, think that they should have very high valuations because then it's benefiting them, which I think often the contrast is true. But I always, if people, I think, sense, and for me that's due diligence and discussing with each other, you very quickly get a feeling for whether you can work together with or not. And to me, that's one thing that's important for me in due diligence. I see how I can and will interact with the founding team, and whether I can agree with them and I can solve problems with them or not. And if I get the impression I cannot solve problems with the founding team, I just walk away. To me, really, the beauty in venturing, and also as a starting company, is you can choose your partners. You're free in choosing who you want to work with. And I think that's a freedom that not many people have in real working life. Okay. Valuation, Todd, Marian, anybody else?
Yeah, we're sensitive. I may be the most sensitive in the room, just because, like I said, we don't, actually maybe not, maybe Mitchell has the same kind of, if he's financially driven, we definitely care about our return, especially as we go later stage, because it gets harder to find the return. Like anything, if you're seeding something, sure, then you have your dreams of your 100x, but when you're sort of saying, okay, I'm going to go in after the 1, I'm thinking like a 3 to 5. Is that reasonable? Am I closing in closer to 5 to 7, or am I 3 to 5? And like, how do I have to move it based on whatever my NPV is, or whatever I think the market comps are, to figure out what the trading multiples could be, given where I think these guys can exit, given the state of play in capital markets, in comp deals that are being sold. So if we don't factor that in, if we're insensitive, we're not going to make money, and if I don't have a strategic interest, why did I do the deal? So that's the easiest way to say it for me.
Sensitivity as well on valuation. Even if we're a strategic investor, we do monitor our financial returns very closely, and then that's definitely something that goes along with any single deal. So, and leading deals is also something we do. We also did some company creation in some cases on our own, doing spin-outs, so we are not afraid to go very early with seed investments and get to work.
Yeah, so, being in South San Francisco, we're sort of positioned near the epicenter of hype. And so we are sensitive to valuation. We've seen fairly frothy valuations lately, especially in the areas of drug discovery enabled by AI and machine learning. And we'll have meetings with other venture funds, the high-tech funds. And there's a little bit of a disconnect. Even though they very much would like to work with us, we sometimes we often have to say no because they're just out of touch. We had one high-tech venture fund meeting recently where they said that their minimum bite size for any round was 100 million, and that's just not what we do. So we are sensitive to that and size the round. We don't like to back up a truck full of money. We think it sends the wrong signal.
Mm-hmm.
So we kind of backed up a truck recently. So we invested in Grail, and we were one of the largest investors there. It's not that we're not valuation sensitive, because I think that we need to return capital J&J because clearly the stockholders expect that. But there are certain things that I think that are believed to be so transformational, and that particular investment in that company also came with each of the strategic pharmas doing work to try and create sort of the blockbuster not blockbuster, but a biomarker sort of the future and early detection. So I think that there are instances where when things are competitive and so transformational that it's hard to understand the return on investment, but by not doing some of those things and not participating, it's just as risky as risking the capital.
And we had already backed up the semi for Foundation Medicine. So
Right. So
sometimes, yeah.
But what's interesting though, and on that note, is leveraging the balance sheet for everything as big as Grail and as tiny as a convertible note is a really powerful way for our R&D organization to place bets that don't cost them anything. And so that's why corporate venture, at least for us, is something that won't go away, and that we also use judiciously, because we don't want the R&D folks saying, yeah, go ahead, invest in that and that and that. So we have a complicated sort of procedure where they actually have some skin in the game for the investments that they co-champion with us. And for us, that's an important way for them to have their own filter for being able to do this. So.
This is actually a question for the panel. Does anybody else do crossovers other than me? Am I the only crossover?
We stumble into them, in other words, in the sense that if it is something that we believe is of strategic interest, like Aduro we were in, for example. But the weird thing about, the interesting thing about that is sometimes our collaboration, which of course if it's successful, helps to facilitate the crossover. And so we have had a number of investments that have, for which the work we've done have either been a wonderful success, anyway, so that it doesn't mean it may be a failure too, but it's a great way for us to, in a way that is getting ownership, and in some instances in collaboration with some sort of strategic collaboration, allows us to do that. But that's one example of a crossover.
Mm-hmm. Yeah, we don't do that. I mean, we're on the other end, right? We go very early, so crossover would be too late for us.
Yeah, that would never be our initial investment.
Yeah. So Alicia, you said you do company creation. Is anybody else doing company creation? Mitchell, you guys are doing that?
So in terms of starting something that is purely an academic endeavor, we are not doing that. That takes more bandwidth than we have. We're only 6 people. It's something that we've been discussing maybe setting up an incubator, but that does take intensive resources to do that. We like the idea. We certainly like the concept of taking an academic idea and putting in the top medicinal chemist that we can find, the top assay person we can find, so that everything is done right from the beginning. But I think Atlas and Flagship are doing a really nice job of these kinds of things. Also Polaris, but we're not there right now.
Mm-hmm.
So we've participated in a variety in collaboration with other venture groups. So it's sort of a collaborative company formation. So Fusion is a great example that recently came out. We just did a second close. It's a company that is developing antibody and alternative scaffold conjugated to alpha emitters for radiotherapy for oncology. So a different way of blowing up tumors to create tumor antigens, like an oncolytic virus. And so Fusion was one thing that we led the formation of that company and put some of our assets into that to enable it. We do sometimes spin outs that are of J&J Technologies or assets, but we don't have the same the machinery that like an Atlas or a Flagship does to do it at scale, where we can have somebody a quarter time in 4 different companies. So it's a little more time consuming for us, but it is something that we are doing. And as you notice, I guess most recently, I think Pfizer just spun out a new co with their assets and folks too. So again, company formation, but like more asset based.
Yeah. I mean, we do company formation with, external PIs. I think historical reasons, we started in Germany, Europe, and the ecosystem there, it's different from the US, you don't have business angels, you don't have serial entrepreneurs that much. And so actually you're kind of forced to create your own companies and, forming syndicates around an idea and finding a management team around an idea. And we did that several times. We continue to do that in the US, and yes, you need a lot of time. You need a lot of time for that. But to me, that's actually like the fun part of it. So I really enjoy much more discussing with a PI at the university or a hospital about an idea and then forming a company around that rather than investing in a Series A where everything is set from the management team to like the clinical plan and everything's there, which is interesting and challenging, but certainly not that fun anymore.
There's an interesting sort of little shortcut structure that we are part of, which is these different sort of accelerators. So we're in the accelerator, which was founded by Arch well over a decade ago, and we're now Fund 4. So we're actually in Fund 4 with a host of other investors that include strategics such as Lilly, Pfizer, AbbVie, us. And so what's interesting is it's a pre-formed syndicate. So if any of you have ideas, you can try and get them funded by maybe a new co-formation or funded by the accelerator. And so it's a way of sort of accelerating into, like, let's say, a larger Series A or B.
Mm-hmm. Mm-hmm. Okay.
For us, I can add a bit more color to the company formation. So we have an incubator in Israel because there was some space in an R&D hub that is over there, and we've secured some labs, and we did a couple of seed investments, actually, one where we are now co-investor with BI Venture, which is called Metabomed, and another, so that was syndicated afterwards. Some other companies were actually spin-outs from Merck AGA at the time of strategic changes, and we've picked assets, and actually some of the team leaders working on those assets were willing to go on and start companies, and then we've really helped them to get the asset out and build also a more functional team, getting external expertise where they needed to be hired.
Mm-hmm. Maybe it's time to talk a little bit about the ideal syndicate, right? How does an ideal syndicate look like, Mitchell?
We syndicate early and often. We don't like to be at more than 20% ownership at transaction for structural reasons and tax reasons. So we syndicate. We tend to have a network of folks we like to work with, but sometimes that ecosystem changes. I guess there is this statistic that, I think Alios, our best exit to date, was composed, I think, mostly of strategics.
Except us.
Sorry.
Except us. We were the one that bought him.
we've often worked in the past with NEA and with Novo, I think also with Pappas. And, some of the folks we've syndicated with historically, though, have changed a little bit. So recently, Flagship Ventures seems to like to own the whole round, and so sometimes there's not as much room for corporates as there used to be with some of the other venture funds. But we think that forming a syndicate helps the company. You get more opinions, access to more resources and expertise.
Mm-hmm. Thank you. Yeah, for us, when I try to put together rounds, I really try to have a mix of institutional as well as corporate ventures. And often, founders ask me, hey, would you mind if there's another corporate venture in there? And I always say, no, of course not. I think it brings more to the company, and investors should bring more to a company than just money. Its perspective, its network, its experience, and that only can help a company. I think in nearly all of our companies, there's at least one other corporate investor in there. Todd?
I actually think it depends a little bit on stage and in terms of number of corporates. I think corporates are great to have in there. I look for a corporate because in a lot of ways I sort of assume it gives me validation from their internal scientific unit. It means they're probably sort of depending if they have a strategic interest in the area, they're taking a peek at this and they're going to create competitive pressure if a trade sale comes about, which is really good depending on where the market cycle is. I don't love the idea of only corporates being in there because if they have strategic reasons for being there, they're not going to necessarily motivate the company as hard as somebody who's like running, like their fund is winding up and they're going to be like really hitting the gas to get something accomplished. So it's good to have the competitive tension in. And I think stage determines if you can have multiple strategics. When you're investing in a platform tech at its infancy and everybody has sort of like a different set of goals and outcomes with what molecules might come out of that platform, that's one thing. But when you're getting into phase 3, it's hard to have two people who are going to compete for the same asset in the same investment. So I think there's an eventual point where you're sort of, if they were already there, that's fine, and probably somebody looks like a front runner, or you're going to create the pressure. But I think later on, it's harder to get two in. That's just an opinion, but I think it's really critical to help it manage the capital market cycle as well as get external validation.
Mm-hmm.
On our side, our corporate finance colleague didn't push back thus far for going to very high ownership. So on that, we have a lot of flexibility. There is actually no threshold. Syndication happens with people we already syndicated with, but we are very much open. We also work with other corporate VCs. So it's all about relationship, but as Michel was saying, people also change, go from one fund to another fund, and you start working with a new fund. So this happens as well.
Rian, anything to add? No?
Same thing.
Good. Yeah, for me also it's a people's business, right? We have a question here, please.
Yeah, have any of you syndicated with Chinese investors who often make a condition of their investment that there be a PRC story, by which they mean an option to buy the company or the out-license of one of the significant pieces of IP or whatever, so as to do clinical trials in China, which I would have thought is sometimes anomalous in some VC syndicates. Could you comment on that?
So maybe I start answering this. So yes, we did co-invest with Chinese investors. No, there's no preferred rights to them. When we invest, we don't take preferred rights. We don't allow anybody else to do that, except it's like a competitive deal, and we believe that, or the board of the company believes that the company profits from that, but it shouldn't be an investment condition. Okay, Marianne?
So I haven't myself. We actually have an investor in China. So what we've decided to do is really focus our Chinese investments in China.
So I have, and we did give rights to the molecule in that territory. It usually comes with a step up to the previous round if the rights are there. And I'm probably a little bit more flexible in this if I have my say in it, because by default, we have an interest in Latin America. So a lot of the times I'll be looking for something similar, so I'm sympathetic to that. And so we can start carving up in what our mind is something that's deprioritized in the list of what somebody has to have. and you could put a catch-all in where you can get necessarily maybe take the rights back and a certain global opportunity. But if you think about where people are going, they're going to start in North America, Europe, then Japan, and you're sort of going down the pecking order, and then China and Latin America are sort of like a lot of times throwaways. So if you can get valuation and extra cash for it, and a lot of times development dollars, we see it as a net positive for the firm. So I'm probably a little bit of an oddball on this one.
So on giving away, we also had discussions with Chinese investors, and some go with equity without any strings attached, no specific rights being given away. So probably you want to first talk to those investors first. On the therapeutic side, giving away China rights, even if you start, North America, there is quite a bit of value. You're living at a table. So I would try to focus initially on the investors that are going pure equity without rights attached. And afterwards, I mean, sometimes you have to be creative, so you don't want to be completely, blocked on something, but that would be second option, I think, for us.
Yeah, I'll only add, we have not co-invested with Chinese venture capital firms, but there are sort of these newer hybrid funds. There's one called Pivotal, which is run by my friend Tracy Saxton. It's a $300 million fund, and it came out of a family office in Hong Kong. Hannah Chang, recently with 5AM, has moved over to manage Madam Wu's family funds, and that's another large fund, and they've put money in. And both of those are based near us in Silicon Valley, so there are other ways to access Chinese capital.
Yeah, and that's for me, it's important when I talk to Chinese investors that they have money in the US and they're able to spend it. I think that's you should take care of. I think we have 5 minutes left. Any questions from the audience you want to ask the panel? Anything?
So some of you kind of alluded to this a little bit, but are there any kind of, obviously there's the advantages of having a strategic in your ground are pretty obvious, but are there any specific deals or times where it really only, benefits more just financially driven investors and it doesn't make sense to have a corporate involved?
Yeah, maybe it's the wrong question for this panel, I don't know. But to me, I mean, when we invest and it's therapeutic molecules, so potential acquirers are pharma companies, right? And so the idea of having actually a potential competitor in the company already, I think is putting some pressure on the acquirer to maybe go higher with a bid compared to there's no other in there. And I think I said I want to have mixed, syndicates. You need the institutionals for actually reaching out to pharma companies, because when I do that, it's kind of like a little bit, strange. But then having corporate investors in there is potentially helping you with the pricing. That's my personal opinion. Marianne?
Yeah, I mean, there's been articles about if you take all of the successful M&As, meaning, large prices, and successful M&Os, like big numbers, and you look at those companies and say, how many of them have corporates? And then you look at the ones that were less successful, it's half. In other words, the ones that the enrichment in corporate venture is double in the ones that are successful. So the question, and like Bruce had a blog, maybe a year ago, about, is it the chicken or the egg? Do corporates pick them better, or do corporates make them better? And it's hard to say, but the bottom line is a corporate sitting around the table is going to create the company in the eyes of what they believe the exit should be based on their R&D. And so if it's about quality, it's about market, it's about all of those things are things that they're going to bring to the table, whereas a financial VC doesn't necessarily, isn't channeling that same, exit potential perhaps. Which of course I'm not saying that the other VCs don't have that kind of savvy, but that enrichment is a specific number that says that if you have a corporate around the table, you're more likely to have a good exit.
Yeah. Anybody else? Feelings?
Yeah, I was going to say, I don't know, if having a corporate would definitely would be a disadvantage, I suppose, if you're purely strategic and the company changed direction and you're no longer strategic. I don't know what happens then, but you know, having the corporates can be a great pipeline, as Marianne was saying, to transactions. So, for example, Flexus Bio, I think, had one of the biggest preclinical transactions in history, and it's Terry Rosen's company. And one of the reasons I think they were able to do that is that you know, they had very savvy investors and were aware that IDO inhibitors were sort of heating up, and they were able to sort of pivot a little bit and capitalize on that. And so just, you know, it doesn't have to be a corporate investor, but at least investors that are connected to the deal ecosystem is helpful.
Actually, that Mitchell makes a good point. I think that, like, I was trying to run through any scenario where it could be an issue. I think that's the one time is if there's a focus change. I feel bad for the management who's doing the next round of financing, who has to explain why that corporate isn't, like, still picking up the slack if they're not participating, because that usually starts to create some skepticism. You see it. It's not that common, but that's sort of the outlier where you can get yourself into a little bit of trouble.
Yeah. Yeah. On that note, we just changed it to financial, so we don't get out, which is good, and we tell our business partners that. So, I mean, if we got out every time they changed their minds, we wouldn't be in venture anymore. So we are really good, I think, corporate citizens in the venture world when it comes to that. So we are in for the long haul.
Yeah, we do the same because obviously pharma changes strategy kind of often. So as soon as they change, then our investments in follow-on rounds become purely financial investments, and that's what we look at.
Yeah. More questions? No? Talking maybe about the ideal exit. What's the ideal exit for you, Marianne?
Oh, the ideal exit is when J&J buys one of my portfolio companies.
That's what you want, yeah. Mm-hmm. At a high price.
Hasn't yet to happen. So far it's been BMS and Novartis, so anyway.
Yeah, I keep saying if you want to sell companies to Novartis, you have to co-invest with J&J, right?
That's right.
Todd, ideal exit.
Maximum return.
Yeah. So, yeah. No, you mentioned you mentioned South America. So there's some strategic kind of thing here, right?
Okay, maybe I should have clarified that a little bit on the strategic flavor, and I didn't talk about this in the terms of spin-outs where we would be interested in. We do like the ability for where there's success. We're going to participate in the upside on the global component, but we're also going to allow our company in Brazil to launch the product for that biotech. And even in some unique situations, and actually it's a company that we invested in alongside Marion, where we think the platform can spin out molecules that we could actually grow as well. So if you can invest in like a great platform tech that can go have a great IPO, sell molecules, and then also participate, and we can help expand what that's doing by buying molecules and bringing them out in JV structures. That's the greatest exit, like where you can touch on all points. So we do want to launch in Latin America. We want to actually help those companies, and this is where we think we can add value, is deprioritize programs for them where it's like number 3 or number 4 on the hit list. But we see value, and especially sometimes there's weird opportunities in Latin America. That does not mean bring me your Zika story, because Zika's not that big this year, but last year you could have brought it to me.
Yeah, okay. Alicia?
Yeah. For us, the same would be big acquisition for our mother company. Then we just tick 2 check marks. We had our success case is F-Star. We invested very early. They did the first deal. The company did other deals with other company, and then there was also an acquisition by Merck KGaA. So that was for us the perfect case.
Mm-hmm. Yeah, Mitchell.
I mean, a large transaction is great, and we sometimes get accused by our colleagues in partnering that we just want to flip things after phase 2 and we don't care about the phase 3 readout, and I would say it's not true. We like creating value for patients, so the combination of financial gain and a gain for patients is key.
Yeah, and for us it's also acquisition by our parent company, which we had once with Virati, that's publicly announced. So that's for the BI Venture Fund. With that, I think our time is out. I would like to thank everybody for his and her attention, and thank you very much for being here.